Welcome to the February 2012 newsletter. This month the market continued to improve as we saw the S&P up about 4.5% for the month of February, which was about the same as it was for January, so the S&P index is up 9.5% year to date. Hopefully this is the market performance we've been so patiently waiting for. A solution appears to have quieted fears in Europe. Our mixed to slightly improving economic indicators have become the focal point. As we're still learning to live under this mushroom cloud after the nuclear explosion of government debt, the upward trend looks like it will continue for the next 4 to 6 months, barring any really bad news events. So we remain fully invested on the equity side. We did reach a bit of a milestone the last week of February. The S&P hit the highest level that we saw last year. But to provide a little perspective, looking back over the last 17 years, the S&P rose sharply in the late 90s to peak in January 2000 at 1,498 on a monthly close. We saw the two massive drops down, bottoming in 2002 and again in 2009, which is the first time we've had two like that in history in so short a period of time. So from the peak in 2002 at 1498 to the end of February 2012, the index has actually dropped 8.5%. Not including dividends, which run just under about 2% per year. So in that 12-year period, the dividends would have made up the difference for the loss, but we still had virtually no gain in the stock market in 12 years, and yet we've had modest returns because of mostly rebalancing and now trend following. This is not the way things will always be. It's an interesting behavioral finance observation. In all my years, I've often had clients look at a monthly drop or quarterly drop in the stock market and extrapolate what that would look like if it continued on that pace and how long it would take before they're completely out of money. In all the years that I've been doing this, I don't think I've ever had a client say to me, wow, we're up 4.5% each of the last 2 months. If that keeps up for a year, we'll make 54% and my account value will double in 1.5 years. I've never had anybody say that, so people tend to dwell on their fears, and they're reluctant to celebrate their successes. And I think that's why it's so important that we have this trend-following software that gives us that downside protection against those catastrophic losses, hopefully. I do have a couple of administrative items this month. We've posted several new videos to our website and to our YouTube channel. Please visit either one, take a look, let us know what you think. We'd love to hear your feedback. If you hit the subscribe button on your YouTube channel, you will automatically be notified whenever we post a new video. It also helps our ranking the more subscribers we had, so we'd appreciate it if you'd do that. Also, please forward this newsletter to any friends or family that you think might benefit from seeing it. We did change our performance reporting software the first of the year and have replaced Asset Book with Morningstar. We're excited about the expanded capabilities that Morningstar has and hope you find it easier to use. You'll be receiving an email soon with login information. Of course, you can still see all your information with up-to-the-minute values at fidelity.com. As always, if you need any help accessing any of your information, just call our office. Thanks for listening. Talk to you next month.